Dave Bartosiak with trending stocks at Zacks.com. So they caught us, and the streaming wars are over. The only survivors would be the folks making the TVs. Netflix, the streaming giant we all thought was going to be a $1 trillion company, has seen its value absolutely decimated. If you Netflix and chilled in November around $690 on Netflix, you woke up at $214 today. $214. Quiet down, and you could hear the sound of the earnings multiple being sucked out of the window. It's not just Netflix either. Warner Media shut down CNN Plus just 1 month after it launched. Disney scrambling to gain market share with their Hulu, Disney Plus, ESPN combo. And Netflix talked about the 800-pound gorilla in the room that nobody ever wants to talk about. That's that sharing passwords, my friends. Sure, sharing a password is fun when you get to log in and binge watch some bake-off that you wanted to see, but it's not so fun when your streaming stock is down 70% now, is it? Let's take a look at Zacks.com to see just how bad things have become in the land of the streamers. So first up is Netflix, currently at Zacks rank number 3. Hold, C for value, D for growth, A for momentum. Help it round out with that VGM composite score of C. Now, here's where things get interesting, right? These estimates. Now, I don't even want to, let's not even talk about sales and earnings. Let's just go straight to these surprises here, okay? So, Netflix beat earnings. Yes, they beat on EPS. 20% better than expected. Quarter before that, 62%. Quarter before that, 24%. See a pattern here? They do a pretty good job of managing EPS expectations. But the problem here, though, is the growth. So now current year-over-year EPS growth, it's a contraction of 3.2%. Now, some stocks like Netflix, and remember the early days of Amazon, no one cared about EPS. We were all about that revenue number, right? So still 10.4% growth on revenue for the current year. Next year is supposed to grow at 12.05. But it's not as big as those numbers used to be. Let's take a look at my favorite chart on Zacks.com. That's the price consensus and EPS surprise chart. Here you can see the carnage. So the multicolored lines represent the evolution of our Zacks consensus estimates over time. The black line is the stock's price. Green arrows, earnings beats. Red arrows, earnings misses. And you can see the price axis on the right side here. Netflix was almost $700. Almost $700 in November. It's $200 now. And notice how the EPS has come down, not just for 2023, but also 2022. So disappointment. And when you have disappointment and you're a growth stock, you get absolutely rocked, especially in a market like this one where everyone is being flogged. Let's take a look at Disney now. They've got their own issues, and it's not just streaming here. Zacks rank number 3, hold. C for value, C for growth, A for momentum, help it round out with that VGM composite score of C. Now let's look at the detailed estimates here. You can see the revenue growth monstrous for Disney, 26% for the current year, 11.8% next year, and that's translating to real EPS growth. 96% growth for the current year, 30% for next year. Those are some really nice back-to-back growth numbers on Disney. Again, price consensus EPS surprise chart tells a little bit of a different story than the Netflix, right? So you got things coming crashing down. Well, that's because they have theme parks, right, folks? So obviously the theme parks weren't doing too well when we were all in our COVID lockdowns. But look what's happened here. This is the strange part. So Disney's kind of topped out as these estimates went sideways and now are ticking down. So what I want to point out is there's still growth. Growth is sort of the difference between these two lines. That's the growth, the year-over-year growth, and then you can pack in there too, right? So you got some decent growth. But these estimates have continued to come down. That's been putting the stock under pressure, but you got to ask yourself, should this stock be 40% off the highs? I'm not so sure. Then if we look at Warner Brothers Discovery, I said Warner Media, Warner Brothers Discovery, you know, that's what it used to be. Now, everybody, since they get merged up, they get different names. Current year EPS, 54% growth. Next year, 10. Sales, 20, and a little over 9. So you're still going to get the growth there, but just not as nice as you're seeing in the Diz. And the last part, this price consensus EPS surprise chart. Honestly, I look at this and I say pass. Overall, not moving in the right direction on these earnings. You got these sort of promises, and then they underdeliver. They overpromise and they underdeliver. So if I wanted to continue to be disappointed, I would just watch the Bears game every Sunday, which I do anyway. So that's what I got, folks. If I'm looking at the three of these between Warner, Disney, and Netflix, I think Disney here has the strongest numbers. That's why you're seeing these analysts come up some of these estimates. Current year estimate going from 409 up to 449. Next year, 561 to 584. Overall, Disney looks like the pick to click out of the three of these big streaming giants. Every time you share this video, one of you freeloaders mans up and pays for a streaming subscription. Subscribe to the YouTube channel, Twitter @Bartosiastics, and check out Zacks.com/promo for this week's deal on finding #1 stocks. For trending stocks and Zacks.com, I'm Dave Bartosiak.